Good morning, everyone, and welcome to the podcast. Today is January 4th, 2025, and we're diving deep into the latest updates from the US stock market. We'll break down the key events from today and give you insights into what you should keep an eye on for the next trading session. So grab your coffee, and let's get started. Let's start with the major indices. The Dow Jones Industrial Average rose 0.8% today, driven by strong performances in the energy and industrial sectors. Over on the S&P 500, we saw a 1.2% gain, with tech stocks making a significant comeback after a sluggish start to the year. And finally, the Nasdaq jumped 1.5%, thanks to a rebound in semiconductors and growth stocks. One of the key drivers today was the release of December's job report. The labor market showed surprising resilience, with 180,000 jobs added last month, beating analysts' expectations. This positive news fueled optimism among investors, especially with consumer spending holding steady through the holiday season. Energy stocks were the standout performers today. Crude oil prices climbed 2.3% after OPEC announced production cuts for February. Companies like ExxonMobil and Chevron posted gains of over 3%. Industrial stocks also shined, with Caterpillar and Boeing leading the charge after reports hinted at strong international demand for heavy machinery and aircraft. On the flip side, the utilities sector lagged. Rising bond yields are putting pressure on dividend-heavy stocks, and utilities felt the pinch today. But don't count them out just yet. With winter storms gripping much of the country, energy demand could give these companies a short-term boost. Now let's talk about some individual movers. Apple gained 2% today after announcing record sales for its latest iPhone model in China. The company's push into augmented reality is also gaining traction, with analysts predicting strong earnings growth for the coming quarter. Tesla, on the other hand, had a more volatile session. Shares initially dropped 3% after the company missed delivery estimates for Q4. However, they managed to claw back most of the losses by the closing bell, thanks to Elon Musk's announcement of a major EV partnership in Europe. Meanwhile, Amazon was up 1.8%, driven by strong performance in its cloud division. AWS continues to be a cash cow, and today's gains reflect investor confidence in its ability to outpace competitors in 2025. As we look ahead to Monday, there are several key factors to consider. First, we're expecting the release of December's inflation data. Early indications suggest a slight cooling in price pressures, which could give the Federal Reserve more room to pause on rate hikes. Keep an eye on sectors like real estate and financials, which tend to react strongly to inflation data. Second, earnings season kicks off next week. Big names like JPMorgan Chase and Delta Air Lines are set to report. Investors will be looking closely at guidance for 2025, particularly in light of slowing global growth concerns. Lastly, geopolitical developments are always a wild card. Tensions in the Middle East could keep energy markets volatile, while ongoing trade negotiations with China may impact industrials and tech. If you're trading these sectors, stay alert to breaking news over the weekend. Before we wrap up, here are a few actionable tips for investors. First, don't overlook dividend-paying stocks in this environment. With bond yields climbing, high-quality dividend names can offer stability and income. Second, consider adding some exposure to energy. The sector has been a reliable performer, and with oil prices trending higher, there's room for further gains. Lastly, be cautious with speculative names. While growth stocks are bouncing back, volatility remains high. Focus on companies with strong balance sheets and clear growth trajectories. That's all for today's episode. Thanks for tuning in to our January 4th, 2025, stock market recap and forecast. Don't forget to subscribe and share this podcast with fellow market enthusiasts. Have a great weekend, and we'll see you next week for more market insights.